Hey everyone, welcome to the third video of the Audit CPA module, where we're going through our online quiz exams, which you can access via our Audit Exam Prep course. And similar to previous videos, the aim is not to complete all the questions or just tell you the answer. Instead, it's designed to walk through a series of examples in detail, showing you the approach, how to use the resources, how to use deduction, any other tips and tricks in order so that you can take those tools, go back and practice those in your own time. We've given you so many different questions that you can go and practice on our exam prep course. So we had 100 in Module 2, we've got almost 70 in Module 3. So the idea is you just keep practicing these over and over and over until you get them almost instantly and all of them correct. And once you're at that point, you should be ready for your final exam. So just do that for all of the modules. Anyway, let's jump right into it. Start Module 3. So the first question for Module 3 is, which of the following audit evidence obtained during the audit of bank and cash would be considered the most reliable? A. Bank confirmation obtained from the entity's bankers. B. Bank reconciliation prepared by the financial accountant. C. Petty cash count undertaken by the junior and reviewed by yourself. Or D. Verbal discussions with the managing director regarding an increase in the bank overdraft limit. Okay, to answer this question, we're going to go to our notes. And we're going to go to Module 3 and talk about the key principles about appropriate audit evidence. Now, whenever you're doing an audit, you need evidence, obviously, to do your test of detail, to do your substantive analytical procedures, to check for fraud and material misstatement, right? So, obviously, you need evidence for that. But your analysis is only as good as your evidence. So, we need to know what constitutes quality evidence for audit, right? So per Module 3, what we talked about was that evidence, this is right at the beginning of Module 3, evidence is more reliable when it's obtained from independent sources outside the entity. For example, a confirmation from a third party, for example, lawyer or bank, is more reliable than evidence available within an entity. And that makes sense, same as we talked about before with, where there's fraud happening. If management tells you that there's no fraud, it might be reliable, it might not be. You go outside and you ask and find out information. If there is fraud happening from an outside perspective, you might get a different opinion. So because that person inside might have bias, might be involved, might have confirmation bias, many different reasons, outside information is always more reliable than than inside information. So it clearly says here confirmation is more reliable than internal management. So if we apply this to this particular question, so we want to know which one of these options is going to be most reliable. Well, this one here is a bank confirmation. So this is external information. So we know per that rule that that's going to be more reliable than any information obtained internally. So let's keep that in our back pocket, but let's check the other ones in case there's a more correct answer. So B is bank reconciliation prepared by the financial accountant. It could be reliable, but chances are that there could be an error, or if this financial account is committing fraud, they might want to cover it up, or maybe a control's failed and therefore it's not reliable. So far, bank confirmation is more reliable than this. Third, petty cash count undertaken by the junior, reviewed by yourself. So same reason as this one up here, not going to be as reliable as the bank confirmation. A, it's internal. B, there could be an error. C, a control could have failed. D, if there's fraud, this junior or the review person could have been working together to cover it up for all we know. And then finally, verbal discussions with the managing director regarding an increase in the bank overdraft limit. Bank confirmation is definitely going to be more reliable than this verbal discussion. This one is it's a confirmed number versus a verbal discussion, which isn't, verbal discussion isn't usually a reliable piece of evidence versus a proper document signed by the bank. Also, internal versus external. External is always going to be more reliable for the same reasons we discussed for these two up here. And then finally, just the managing director is probably not going to be as across the detail as, say, an accountant or an auditor or a bank, right? So clearly A is going to be the correct answer here. All right, question 2. So audit procedures are designed to determine the existence of material going concern uncertainties. All right, next question. Audit procedures are designed to determine the existence of material going concern uncertainties. Which of the following going concern situations is least likely to be identified from an analysis and review of the entity's financial statements and accounts? Note the question says least likely to be identified. And a going concern issue, if you remember, is basically any issue which might threaten the fact that the business can continue to operate in the future. So afford enough cash flow to pay its debts, make money, etc. So, for example, loss of major customers would be a going concern threat because, they're the ones paying the bills, keeping cash flow going in the business. If that customer goes away, cash flow might not be, high enough to support short-term and long-term debt, for example. The business might go bankrupt. Recurring operating losses is another thing that might, cause the business to go bankrupt. But we could probably identify operating losses from looking at the financial statements, right? Because it's basically just the P&L, and that will indicate an operating loss. Working capital deficiencies is another thing which could potentially, if they're big enough, if the deficiencies are big enough, could trigger a going concern. For example, if they've got, $10 million, think about Tesla, right? They've got billions and billions of dollars locked up in building new factories all around the world, developing new, battery product lines and things like that. A lot in equipment, etc. So it's very easily that something could happen to Tesla where, because they got all this money locked up in working capital and PP&E, that they, just don't have enough money to pay short-term bills, especially if something unpredictable comes along that requires them to have a lot of cash in a short amount of time. But again, that's something that you could probably pretty easily identify just from looking at their financial statements, right? From the balance sheet, from the cash flow statement. And then finally, regulatory breaches for industry licensing. So, look, that could potentially be a going concern situation if the industry that they're in is particularly reliant on an industry and they need that license to operate. So, for example, like if they operate a casino, for example, and they lose a casino license, they need that casino license to kind of operate the casino. And if they don't have the license, then they can't really generate cash flow. The business might be insolvent, right? So clearly, B and C are not the right answer, right? It's not. These are all going concern risks, but these two are very easily identifiable within the financial statements and accounts. So the only ones that are kind of 50-50 or not super easily identifiable from the financial statements and accounts is A, loss of major customers, and potentially D, regulatory loss of breaches for industry licensing. So if we're 50-50 between customers and regulatory breaches, you're more likely to be able to tell major customers are going to be, you're more able to identify a loss of major customers from the P&L, right? For example, you'll have less revenue in the P&L, maybe cash flow, you have less cash flow coming in, and presumably it's in relation to something from the previous year. But regulatory breaches for industry licensing, I don't think you're necessarily going to see that unless that's something, that happened a long time ago, but by then the business might have gone out of business, right? So this is something that you probably want to look in the kind of the minutes, for example, which isn't part of the financial statements and accounts, or by talking to management, etc. So this one's probably the most correct answer. This one's not far behind, but I think this one's definitely the clear answer here. Regulatory breaches for industry licensing. It's definitely not those two. Those are obviously identifiable from the financial statements. So let's go with this one, regulatory breaches. And yes, that is the correct answer. Good work. Cool. So next question. Okay, so Adam Up is auditing the accounts receivable of a retailer and noticed that a majority of the receivables balances are large. Further, the controls are ineffective and cannot be relied upon. To best determine the accuracy, valuation, allocation of accounts receivable, which of the following audit tests should Adam Up perform? A. Perform subsequent receipts testing. B. Match invoices with purchase orders. C. Send a negative confirmation request. Or D. Perform a credit check on the customers. Okay, so the first option, perform subsequent receipts testing. Let me just explain what subsequent receipts testing is. So basically, let's say you've got a December year end for your business. So what you do is you look at your cash flow in January and maybe February as well. And you look at for example, in the case of accounts receivable, you look at the amounts that have come in from customers, right? And then what you do is, even though we're not looking at that year, that's referring to the next year, you're looking at the cash flow, because if the money's come in then, it means something must have existed at the point of December, right? Or most likely it's existed at the point of December. So you can just match that back to the accounts receivable ledger as of December. And if it doesn't tie, you've got an issue. And if it's not there in December, it means you've got an existence issue, right? Because it's money that's completeness issue, because there's money that's come in, so it does exist, but is it recorded in the GL? So this is probably a good test. And also, if you do a Control F in your notes for subsequent receipts testing, you'll notice that the only instance of it actually takes you to, see, it's the only instance there, it actually takes you straight to this section in the notes, which is about tests of transaction account balances. And it actually says here that for the accuracy, valuation, and allocation assertion, the collectability of accounts balances and related procedures, testing of subsequent receipts must also be considered. So this is a very common approach for actually assessing valuation of balances, because if the cash flow is there, it's a very easy way to go, okay, well, something must have existed in December. Let's just check those against December. If it's not there, we need to add it in. If it is there, it gives us confidence that it's right. So far this one's looking pretty good as the correct answer, because A, it makes sense logically as a form of checking the existence and accuracy, valuation, allocation of accounts receivable. And it's also mentioned in our notes as well. So secondly, matching invoices with purchase orders. I mean, it's not really a check, right? In our videos, we went through what a good wording for an audit test would be. It would be select a sample from this date, check the purchase orders or the invoices against the balance in the accounts receivable, and if they tie through, then most likely it's accurate, right? But the reality is this is more of a control rather than an audit test. Matching invoices with purchase orders. So there's no specific sample, there's no specific date range, there's no check it against that, and if this is this, then do this, right? It's just a process. So they should have been doing that throughout the year anyway. So this is more of a control. And if they find out, like if they're doing a test of control and they find out that they haven't been doing this process, well then clearly we need to do additional work. And one of those pieces of work would be, for example, doing subsequent receipts testing. But that just shows you that this is a control, not an audit test. So thirdly, sending a negative confirmation request. So you generally only do a negative confirmation request when your controls aren't working, and that's when you actually do that extra work. So if we just do a Control F in our notes for negative confirmation check, the other issue that you'll find is that negative confirmation requests are less reliable and generally used where there's a large number of account balances which are relatively small, or where inherent or control risks are assessed at reduced level. So it's not ideal in this situation because A, it's generally used as a backup when the control fails. It's probably better suited when there's a couple of larger invoices that are owing that you can just go and do a confirmation. Generally, accounts receivable balances, it says here in the notes that may be used where a large number of individual account balances are relatively small. In the question they've given to us, it says that the majority of account balances are quite large. So negative confirmation doesn't work very well in that situation. So I don't think this one's going to be correct on that basis. And then let's finally check D, perform a credit check on the customers. And again, that's going to be a control process rather than a test, because that's something that prevents issues rather than as a check for issues. Same as this one up here. It prevents issues rather than as a check for issues. So if we do a credit check on customers whilst we're doing the accounts receivable, we can check which customers can actually pay it back and which can't, and those which can't pay it back, we don't issue them any credit, because that's going to reduce the risk of bad debts and therefore an inaccurate evaluation of our accounts receivable. Okay, so just to quickly recap, subsequent receipts testing we said was an okay test to use for accuracy, valuation, allocation, and as per the notes, it was actually a pretty common method of doing it. Match invoices and credit check were both controls rather than a test, and a negative confirmation request is probably okay, and it's definitely better than those B and D answers, but the reason why we're not going with this one is A, it's generally used when a control fails first, and secondly, it's more appropriate when there's a large number of small balances, and in this question, it's a small number of large balances, right? So the opposite. So clearly, A in this question is going to be the correct answer by deduction. All right, next question. So the auditor of XYZ Pty Limited has tested 100% of the population. Which of the following statements is correct? A. This replaces audit skepticism as the evidence covers all items. B. The auditor can issue an absolute assurance which is higher than reasonable assurance. C. The only way to achieve 100% testing is through the use of CATs. And D. The highest level of assurance that can be issued is reasonable assurance. So this is one of those questions where if we were to refer to our notes, it's going to be coming from a whole different bunch of places. So it's much better that you have a strong foundational knowledge by watching the core content video for questions like this, so we can just get through it quite quickly because we know already the core concepts. So the first thing, I'll go through part one. So this replaces audit skepticism as the evidence covers all items. So you can never get rid of audit skepticism. If you don't have audit skepticism, then the effectiveness of your audit quality is very low, right? Because skepticism, you need skepticism, right? For example, you have tested 100% of the population. How do you know that the population is 100%, right? If you're just accepting that and someone just gives you 10 items and says it's everything and you don't have skepticism, then you're more likely at risk of, or audit risk, right? Saying that there's no issues when in reality there are issues, risk of material misstatement or fraud, right? And also just because you might have covered 100% of one particular population, for example, a petty cash journal, right? Maybe they never use petty cash. Doesn't mean that you can just remove audit skepticism for the rest of the engagement. What about the rest of the complex accounts? What if there's fraud somewhere else in the business, right? So clearly A is incorrect. B, the auditor can issue an absolute assurance which is higher than reasonable assurance. So what I would like to show you is the earlier chapters where we went through and saying that there's no such thing as absolute assurance in audit. There's no possible way that you can say to someone, there's no fraud in your financial statements, right? It's impossible to know. And you can't say there's no material misstatement in your financial statements. Again, impossible to know. There are billions of transactions in some companies, and even if there isn't billions, even if there's a manageable amount, you can't check every instance of a business. Some things are hidden, some things that's just too complex or too large to identify, and audits generally don't have enough resources to look at all of them, right? So the aim of an audit is to just get that risk to an acceptably low level rather than offering absolute assurance. So clearly B is incorrect as well. So C, the only way to achieve 100% testing is through the use of CATs, right? This is the computer analytics, right? This is also incorrect. So I used the example of the petty cash one, right? You can still have a complex business and still have some accounts which only have like 6 journals in them, right? There's some accounts that just don't have much going on, and you can easily go through 6 journals manually yourself. You don't need a computer to analyze it. So yes, you do use CATs for highly complex accounts with millions and millions of journals, but the same company can also have 6 journals in petty cash. So you don't need a computer to do that one. So C is also incorrect. So by deduction, you'd think D is the correct answer, but let's just double check it. So this says the highest level assurance that can be issued is reasonable assurance. Again, that is correct. We talked about assurance in chapter 1, the definition of assurance, and how there was 2 types, right? There's reasonable assurance and limited assurance. And reasonable obviously offers more assurance than limited assurance, but in no case can you offer absolute assurance. So clearly D is the correct answer here. Okay, cool. So we didn't actually need to refer to our notes in that one because we had that strong foundation from watching the core content videos. So some of the questions we can only refer to the notes, and some of them we can't refer to it at all. So it's good to watch the core content first and then go through these videos, which is why we structure the courses like this. All right, next question. Which of the following audit procedures would help an auditor in identifying related party transactions? A, performing analytical review to determine if an entity has going concern problems. B, reviewing solicitor's response to determine if potential contingent liabilities exist. C, reviewing confirmations of loan receivables and loan payables for determination of guarantees. Or D, review of trial balances and general ledger for recurring transactions which were recorded just after balance sheet date. So we can do this 2 ways. We can do this the logical approach way, which is to work through each answer and just use logic basically. Or the alternative way is just to do a Control F in the notes for related party transactions, and it should come up with some pretty useful help there. But let's start with the logical one first. So remember, related party transactions is where there's someone very close to the business, right? For example, the CEO's wife has a business or a rental agreement or a supplier agreement, or whatever it is, some sort of business transaction with the entity. Now, you might think, why is that an issue? Well, statistically, there's a much higher chance of either a non-arm's length arrangement going on. For example, instead of paying market rate rent, the CEO's wife gets to, a much higher rental agreement. Or maybe she runs a business which supplies the entity with, say, cost of goods sold for a much higher price than its competitors, or maybe it's not the best option for its competitors. There's just a couple examples, but statistically there's a much higher chance of a non-arm's length or fraudulent transaction occurring as a result of that related party transaction. So wherever we see a related party transaction in audit, an auditor is actually, per ISA 550, is required to understand at least a sufficient understanding of the related party relationships and conclude that those related party transactions have been appropriately identified, accounted for, and disclosed appropriately in accordance with the IFRS, right? Because of that additional risk. And they should also inspect records in relation to those documents, including minutes, bank, legal confirmations, and any other records. Okay, but the question is asking us, now that we've gone through, the background of related party transactions, the question is asking us what procedures, like if they didn't tell us about this, what procedures could we do to help the auditor identify for these kinds of transactions, so look for them. So A, is a performing analytical review to determine if the entity has a going concern problem? Well, none of this is really to do with a related party transaction, right? So an analytical review, just pretty standard process. Going concern problem, that's to do with like cash flow, like revenue, looking at risks to the business, like losing a customer or losing a license, or, nothing of that's to do with related party transactions. It's just not relevant logically. All right, B, reviewing solicitor's response to determine if potential contingent liabilities exist. Again, this is just not related to related parties. What's that got to do with the CEO's wife or, the chairman's brother, right? It's just not related. C, reviewing confirmations of loan receivables and loan payables for determination of guarantees. So this could potentially be related to related party transactions because A, someone like the CEO or the chairman and their family and friends and related parties are more likely to either have a loan or a loan receivable or loan payable. For example, let's say the CEO is borrowing money from the company to use for his personal money. That's a related party transaction, but it's a common practice for small businesses and medium-sized businesses for owners to kind of use money like as if the company's money, as if it was their own money, but it's not their own money, right? So that's an easy indicator that potentially there's some sort of related party transaction going on. Or alternatively, looking at the guarantees as well. So there might be, someone who is a related party actually guaranteeing one of those loans. But we'll come back to that one. So D, review of trial balance and general ledger for recurring transactions which were recorded just after balance sheet date. This is a good test, but it's not specifically a test for related party transactions. It's more of a test in relation to the cutoff assertion, right? It's a common test that auditors do, but they don't do it specifically for looking for related party transactions. They do it to ensure that the balance date transactions are reported accurately. So clearly C is the only leftover one, so it's probably going to be the right answer, but I just also want to show you the other option, which is looking up related party transactions in the notes. That's going to take you to this section here, which is audit procedures for related parties. And as you can see down here, this is the key points that I was giving you an update on, but it says down here in red, so the key point, reviewing confirmations of loan receivables and payables may reveal unusual transactions that could have related party implications for an auditor. So clearly, if you go either route, either the logical one or just checking the notes, clearly C is the correct answer to use. All right, next question is, you are undertaking the audit of Apple Limited. After a year end before the accounts were signed, you were advised that Banana Limited obtained a non-controlling interest of 15% of Apple Limited. What should the auditor do in the above situation? So keep in mind the dates. This is after year end. So you're the auditor and you've received a trial balance for, let's say December 2020. Now, so you've looked at that balance sheet and you're going to do the audit after year end, obviously, right? Now, during the period after they're giving you the results, they also find out that Banana Limited obtained NCI in this other company. So this is an adjusting or non-adjusting event, right? So we need to figure out what do we have to do in this situation in that time frame, whether the situation existed at the time of the accounts and so forth. So this kind of event is called a subsequent event, right? So if we do a Control F in our notes, we can do a quick recap of what a subsequent event is. So what I'm going to do is click here. It's going to take us to the section on subsequent events from page 236. So these are basically events occurring between the period end and the date of the auditor's reports, i.e. facts discovered after the date of the report being issued, but before the report being signed, right? So there's this flowchart that we can follow in terms of, do we need to amend the reports? Do we need to disclose the reports? Is there any disclosure required at all? So all we need to do is follow this flowchart, and the key question to ask is, does the event provide additional information about an event that existed at the end of the reporting period? Or in other words, did this exist at reporting date? I.e., did this acquisition, was this known about at 31 December or before? And this is just something that has, settled afterwards. For example, they had been in discussions and then signed an NBIO, or non-binding indicative offer, at 31 December, but they hadn't proceeded to settling the acquisition, or they weren't 100% sure. And then in between the accounts ending and the accounts being signed, they decide, yes, let's go ahead, and they proceeded with the acquisition. In that case, we would go up the yes and go up this way, but that's only if the acquisition was known about at the end of the reporting period. So let's have a look at the question. It doesn't say anything about the acquisition being about the acquisition event existing as at that date. So unless it says something along those lines, logically the answer is no, it didn't exist at that date. So we're going to go down the bottom half of the flowchart and go down here. So this is a non-adjusting event after the reporting period. So basically no adjustment is permitted per paragraph 10, so you don't change the financial statement numbers at all. But then we need to figure out if there's a disclosure or not. So the question is the information material? Generally, you would think an acquisition is fairly material. It's generally a large amount of money. It's a material operations decision. So I'm going to say yes. The answer is yes. So disclosure is required per paragraph 21. And the notes to the financial statements need to disclose this, including a description of the event, like the nature of the event, as well as the estimated effect, financial effect. So the answer to this one would be disclose the acquisition in the auditor's report. No. Advise management to adjust the balance sheet. No, because we're not adjusting. C. Advise management to disclose the acquisition in the notes to the financial statements. Yes, that is the closest one there, because there's no adjustment to the fin stats, but we do need to disclose it in the financial statements. So the answer is clearly C. Click that. That's the answer. All right, next question. Which statement best describes tracing a sample of transactions to test for inventory completeness? So what I would do first is just confirm what the definition of tracing is, and that's a fairly simple task to do. We're just going to do a Control F in our notes and look up tracing, right, and just confirm what the definition is. So here it is over here. It should be the first result you type when you type in tracing. So basically, tracing involves testing from the source documents or underlying assets to the accounting records as the auditor tests for completeness by comparing the physical count to the ledger. Okay, so let's have a look at the options again. So A, tracing items from the ledger to the stock take records. B, testing from the accounting records to the underlying assets. C, tracing items from the physical count of inventory to the underlying assets. Or D, testing from the underlying assets to the accounting records. So let's just revisit the definition. So it's either from source documents or underlying assets to accounting records. So we know accounting records need to be the second part, and the first part can be either source documents or underlying assets. So the easy part is just to look for accounting records as a second part. So this one says accounting records. This one says, well, stock take records maybe. These ones are underlying assets as the second item. So we can write off B and C. And the first part is ledger to stock take records. This one's underlying assets to accounting records. This one, underlying assets, I'm just comparing against this definition. So it looks like D is the closest in definition to this. So it's got underlying assets to accounting records. See those words there? Underlying assets to accounting records. So clearly D is the closest to that particular definition wording. So let's just go with that, and that's the correct answer. Cool. Next question. Which of the following best describes the auditor's understanding of why internal controls are developed by the company? A, prevention and detection. B, frequency and effectiveness. C, effectiveness and efficiency. And D, efficiency and implementation. So you might be able to answer this one based on your common knowledge from understanding the core content, from watching our videos on the core content. If you want to look up the textbook for this one, what I would do is I'd just look up the relevant sections on internal controls. Now what I'm going to do is I'm just going to scroll down a little bit on Module 3 because I know that there is a section there on test of controls. So I'm just bringing that up now. So test of controls, Module 3.2. So it basically says assertion level controls directly relate to the prevention or detection and correction of misstatements. So it's about having these processes in place which prevents or detects misstatements. So which of these is best fitting that? Well, I can see this one has the exact same wording, prevention and detection. Makes sense because the prevention part of the control, for example, one example of a control that I was giving you before is in a payroll software, if the employee equals casual, do not allow input of casual sick leave. Now, if you didn't have that control in place, what that means is there might be instances of error in the payroll data, right? So it's preventing payroll errors. And also detection. So another example of control might be after the accountant has come up with the journal, he gives it to his manager for review. The manager then checks it, signs off on it, right? In that case, the control is the review process, and the purpose of that is detection. So it could be prevention and detection. So clearly this is the correct answer, both from the logic perspective and also from just the quick one looking up in the notes. So let's go with that, A, and that's the correct answer. All right, next question. In relation to a public company listed on the ASX, when should the management representation letter be dated? A, at balance sheet date. B, at the date when the audited financial statements are lodged with ASIC. C, at the date when the audited financial statements are lodged with the ASX. Or D, as near as practical to, but not after, the date of the auditor's report on the financial statements. So simple approach for this one. All we have to do is do a Control F for management representation letter. That is going to take us to the section in the notes on management representation letter, which I am bringing up right now. There's only a couple of examples of it, pretty easy to find. So this is basically a letter towards the end of the audit from the organization's management, which contains representations from management to an auditor made during the audit. And the purpose of that is it impresses upon management its ultimate responsibility for the content of the financial statements, and it confirms in writing any representations made by management during the conduct of the audit. Now, as per usual, the red points are kind of the important points, so probably the relevant one for us here, I can see is just around timing / the date of the report. So it says here, ISA 580 written representations, paragraph 14 states the letter must be dated as near as practicable to, but not after, the date of the auditor's report on the financial statement. So how does that tie in to this? So which one of these options closely resembles the date of the auditor's report on the financial statements? So the date of the auditor's reports on the financial statements. So it's clearly D, right? Because everything else doesn't fit in with what it says there. So per ISA 580, must be dated as near to practicable, but not after the date of the auditor's report on the financial statement. So it's clearly D. All right, next question. So which of the following relating to the use of using the work of an auditor's expert is correct? A, the auditor has shared responsibility for the audit opinion with the auditor's expert. B, the auditor's expert is used to obtain sufficient appropriate evidence in the accounting and auditing field. C, an auditor's expert is required in order to obtain sufficient appropriate audit evidence in a field other than accounting or auditing and to reference the work in the audit report. And D, the auditor's knowledge and previous experiences with the expert should be considered in determining the nature, timing, and extent of audit procedures. Okay, so what I would do for this one is I'd actually do a Control F with these keywords, using the work of. Now, the reason I'm doing that is because it could be using the work of, I don't know exactly how it's worded in the notes, it could be using the work of an auditor, like an internal auditor, or could be using the work of an expert, or could be using the expert of a component auditor. So these are all different concepts, but either or it's probably a similar category, right? When you're using the work of someone else in your audit, there are certain key principles that apply to all of them, including, you are ultimately responsible. Like the partner of the audit or the person starting the audit report is ultimately responsible for everything, all of the statements made within the audit report. You can't just blame the work of another auditor. So that's the key principle, but there's also some specific ones depending on whether it's an expert, internal auditor, component auditor, and so forth. So what I would do is I would bring up the notes and I'd just do that Control F for using the work. You can see there's not a lot of options here. So what I'm going to do is I'm going to go to one with the title. I can tell it's a title because it's going 3.6, using the work of other auditors and experts. So this bit's the one I want over here, experts. So we've got component auditors first, then we've got internal auditors, and then we've got using the work of an auditor's expert. Okay, so this is probably the bit that we want here. So an auditor's expert is defined as someone who possesses expertise in a field other than accounting or auditing, but whose work is used by the auditor to assist in obtaining sufficient appropriate audit evidence. So for example, if they've got some sort of really sophisticated financial instruments, maybe they're going to get a person in who can value that. Maybe it's a company that holds, Bitcoin and they want a valuation on that. Maybe it's an estimation of oil and gas reserves, or maybe it's liabilities associated with insurance contracts, right? So it's all this complex stuff that, an auditor can't be expected to know everything, right, and have skills in every different topic. And that's why you bring in an auditor's expert. But as you can see here, the important text in red here, it says, in determining the nature, timing, and extent of audit procedures, the auditor should consider their knowledge and past experiences with the expert. And I think that's the answer here, right? So just reading through these again, the auditor has shared responsibility for the audit opinion with the auditor's expert. I mean, ultimately no, because it's going to come back on the auditor. B, an auditor's expert is used to obtain sufficient appropriate audit evidence in the accounting and audit field. Yes, they are used to obtain sufficient appropriate evidence in accounting and auditing field, but only in specific areas of expertise. This seems like a very general, broad. We're not sending them out, going out and doing testing and sampling and requests for information. It's only for a very specific topic, right? And I don't see that covered in this question here. C, an auditor's expert is required to obtain sufficient appropriate audit evidence in a field other than accounting or auditing and to reference the work in an audit report. So it's required to sufficient in a field other than accounting and auditing and to reference the work in the audit report. So this one's incorrect because the auditor is ultimately responsible for what's in the audit opinion, and therefore they're the ones who have to refer to the work in the auditor's report. So the independent expert doesn't do that because they're not responsible for the, opinion in the audit report. So that's why C is incorrect. And then finally D, even if you weren't sure about C, we know that D is the correct answer because this matches the wording that we just went through in the notes over here, which is, in determining the nature, timing, extent of audit procedures, the auditor should consider their knowledge and past experiences with the expert per ISA 620, paragraph 8D. Clearly that matches this wording almost perfectly. So we're going to go with that as the correct answer, and that is the correct answer. Cool. All right, next question. Which of the following would not be considered a substantive audit procedure? A, obtaining a letter from the bank confirming a bank balance, or an account balance, I should say. B, using audit software to identify all trade debtors over 90 days outstanding. C, taking a sample of purchase orders and checking that all orders over $10,000 are authorized by a purchasing officer. And D, multiplying the number of employees on each pay scale by the yearly pay rate to determine an estimate of payroll expenses. So just to recap what a substantive audit procedure is, it could be a test of detail or it could be a substantive analytical procedure, right? But it wouldn't include a test of control, for example. Okay, so A, obtaining a letter from the bank confirming an account balance. That's going to be incorrect because that's a test of detail because you're requesting an amount of detail and you're going to check that against the detail. So that's a test of detail. B is using an audit software to identify all trade debtors over 90 days outstanding. So this is also a substantive audit procedure because you're using a CAT, C-A-A-T, to check a large number of detail for that. C, taking a sample of purchase orders and checking that all orders over $10,000 are authorized by a purchasing officer. So this is a test of control rather than a test of detail or a substantive analytical procedure because you're checking the control that the control is a preventative and identifying process. In this case, they're checking two orders. So that's what they're doing internally. And by checking the two and are authorized, it helps prevent fraud, right? So that's a test of control. So that wouldn't be part of the substantive audit procedure. So then most likely this is the answer we're looking for. And then finally, D, multiplying the number of employees on each pay scale by the yearly pay rate to determine an estimate of payroll expense. Well, that would be a substantive analytical procedure, right? It's looking at the drivers to estimate a closing balance, which is the payroll expense for the year. So test to detail, analytical procedure, substantive test, substantive analytical procedure. This is a test to control, therefore that's the correct answer, or the incorrect one, but that's what we're looking for. Okay, so we might just do one more question, then we might wrap up this video, because I think we've achieved our purpose here of we've been through enough questions to show you, how to approach it, how to use the notes, how do you think and kind of structure the different questions. What are the tips and tricks to kind of do a little bit better? Which questions are look at the detail in the notes, which questions are use your logic, learn from the core content videos. So let's do this last question, and then we'll move on to module 4 in the next video series. Okay, so for this one it says the auditor uses generalized audit software to audit the inventory master file of an audit client. Fields in the inventory master file include quantity on hand, quantity purchased this year, quantity sold this year, date of last sale, cost price, recommended selling price, and last sales price. Which of the following analysis is an exception report that can be produced from the information stored on the client's master file to assist the auditor in the accuracy, valuation, and allocation assertion for inventory? Is it A, a report highlighting those inventory items where quantity purchased this year is greater than quantity sold? B, a report comparing the master file's totals of quantity on hand times cost price with quantity on hand times last selling price? Is it C, a report comparing the master file's total of quantity on hand times cost price with quantity on hand times recommended selling price? Or is it a report highlighting those items where there is a positive inventory on hand but last sale date is greater than 3 months before year end? So I guess the first thing to consider is what test are we looking for? So the assertion we're trying to prove is for accuracy, valuation, and allocation, and it's for inventory. So whenever we see accuracy, valuation, allocation, we're not thinking about theft inventory, because that would be more to do with existence. But remember we talked about this in an earlier video about, for example, trade receivables. That would be to do with looking at debtors over 90 days, because some of that might not be recoverable. Therefore, the dollar value per item might be lower than what we think it is. So that's the valuation item. So a similar kind of thought on inventory. We could start thinking, probably the key one is obsolescence, right? I think there was an earlier question in one of the videos where we went through this process as well, where we said the key thing that we want to check for accuracy, valuation, and allocation for inventory is obsolescence, right? And I think that the question was saying something along the lines of it had a short inventory life and there was a lot of competition, and the product life cycle was very short. So the risk is you buy stock for $1 million, and then because new competition's coming out that's more innovative, people don't want to buy your stock, so the value that's half of it or 25% of what it was, and then that's the risk that we want to identify, so that shareholders don't think this company has $1 million of stock when in reality they can only get rid of it for $250K, right? So we want to know which of these tests is going to indicate obsolescence for us, and specifically we want to know an exception report. So what an exception report is it's looking for things that are kind of outliers, right? Outliers like, if someone's posting journals at 2 a.m. in the morning versus, 90% of the journals being at between 9 and 5 or 9 and 6 p.m. and then you get a couple of journals posted at 3 a.m., that's obviously a little bit weird. So the exception report is trying to pick out all of those outliers, because there's a higher chance than normal that those outliers will contain some sort of error, misstatement, fraud, etc. Right? Because if you're going to commit a fraudulent invoice, maybe you're coming in the middle of the night into the office to post the journals, right? Okay, so just to recap what the possible answers were. So a report highlighting those inventory items where quantity purchased this year is greater than quantity sold this year. So, that's not necessarily a bad thing, right? Just because you're purchasing more goods than you sold. That might just be part of the ordinary course of business, right? Maybe you're expecting a big year of demand next year. So I don't think this is necessarily indicative of obsolescence in inventory. So let's just keep that in mind and move on to the next one. So this one's talking about comparing the master file totals of quantity on hand times cost price right? That would basically tell you the dollar value of all of your stock, the cost price of all of your stock, with quantity on hand times last selling price. Again, it's not really going to tell you a lot because you're comparing two different levels. One, you're talking about cost price, and the other one, you're looking at selling price. And obviously, your selling price is going to be higher your cost price. That's why you have a gross margin, right? You need to make a profit somewhere. So it's not really a comparable report. It's not an exception report either. It's just kind of comparing your total COGS versus your total sales. So it's not really going to tell you anything other than your gross margin. C, a report comparing the master file totals of quantity on hand times cost price. Again, that's going to tell you your total inventory cost with quantity on hand times recommended selling price. So it's really just the same as this one, except instead of last, it's recommended. Again, not really going to tell us anything, but instead of comparing inventory cost versus revenue, it's going to be comparing inventory cost times recommended revenue, which might be different to your actual revenue. Again, not really going to show us obsolescence in inventory, right? So the final one we're hoping is the correct answer, because the other ones haven't been great so far. D is a report highlighting those items where there is a positive inventory on hand at year end, but last sale date is greater than 3 months before year end. So this is a good test of possible obsolescence, right? What does it tell us? It means A, we have inventory in stock because it's positive. So we've got stock on shelf, but the last sale date is greater than 3 months. That basically means that you haven't sold this item despite having it in stock for more than 90 days, which is a long period for your stock sitting there. So that might identify stock which you can't sell, or in other words, might be obsolete. So let's say you've got an iPhone 5 in stock, but they've already released iPhone 6, 7, 8, 9, 10. No one wants to buy an iPhone 5, everyone wants to buy an iPhone 10, right? So you've got this iPhone 6 sitting on the shelf, still trying to sell it for $1,500 or whatever it was, retailing it back in the day. No one wants to pay that money for it. That's why it's sitting there on the stock. That means it's obsolete. There's newer models coming out, there's better models, there's cheaper models coming out. So this one here is a good exception report to indicate for obsolescence, which is a key indicator of accuracy, valuation, allocation for inventory. So that's why D is the correct answer. All right, let's leave it there for Module 3, multiple choice questions. We'll come back. But what I recommend doing is, now that you kind of got the idea how to do the Module 3 questions, do the rest of the questions yourself in your own time. Take as much time as you need, but before your exam, try and finish all 70 questions for this and finish all of the previous modules as well. Anyway, I hope you found this video useful, and good luck completing the rest of the questions in Module 3. And I'll see you in the next video where we'll go through some of the Module 4 questions. So I'll see you then.